Welcome to ForexTV.com's PM Exchange. It's Tuesday, January 29th. I'm Remy Hoki. Today we're joined by Brad Setzer, Fellow for Geoeconomics at the Council of Foreign Relations. Good afternoon, Brad.
Good afternoon.
Thanks for joining us today.
My pleasure.
Well, first of all, I'd like to start out with a broad outlook for the U.S. dollar. The market is awaiting the federal interest rate announcement tomorrow afternoon at 2:15 p.m. Eastern Time. Well, last week we got the surprise rate cut of 75 basis points for both the Fed funds as well as the discount rate. So right now there's a division over whether we'll get a no interest rate cut, 25 or 50 basis points. So if you could explain what factors we need to keep our eyes on in the short term.
I think the obvious short-term factor is the one you mentioned, is the Fed's rate decision. I think the market is now puts a higher probability on a 50 basis point cut than on any other outcome. And I would assume that that's not fully yet priced into the dollar, so that would at least directionally be dollar negative. And so I think in the near term, that is the obvious risk. Looking out just a little bit further, I think it's the main question is whether Europe and the U.S. will continue to be at different points in their economic cycle, whether the Fed will be continuing with further rate cuts, and whether at some point economic weakness will spread to Europe and prompt the ECB to also join in a rate-cutting cycle. But so long as the Fed is cutting and the ECB is on hold, directionally at least, that's dollar negative, although at some point the euro's strength will start to contribute to the weakness in economic activity in the Euroland, which will sort of introduce some limits on that cycle. But I'm not sure we're quite there yet.
Okay, while we're still on the topic of central banks, the market has been focusing on the ECB as well as BOE and whether we were getting dovish or hawkish comments out of those central banks. But while we're discussing monetary policy and we're focusing on comments from the central banks, in the short term, interest rate cuts are expected to hurt the U.S. currency. But tell me, how does a weaker dollar affect conditions domestically here in the U.S. economy?
Well, I think the weaker dollar right now is a reflection of broader economic weakness in the United States. And when domestic demand isn't firing on all cylinders, it's helpful if net exports can pick up the slack. So the dollar's weakness has contributed to the improvement in the non-oil trade balance, particularly an improvement relative to, say, Europe and relative to Canada, those portions of the world which have seen their currencies appreciate against the dollar. The improvement vis-a-vis Asia has been much more modest. And so I think at this point in the economic cycle, given concerns about domestic demand and about the strength of U.S. economic activity, the additional support provided by net exports is a positive.
Okay, while we're talking about other economies in relation to the U.S., let's address China. I know that you focused about this in your writings, but we've seen a record rise in China's foreign assets. And so if you could tell us about the appreciation of the Chinese currency, the renminbi against the U.S. dollar, and how this affects China's exports.
Sure. China has allowed the renminbi to appreciate at a faster pace against the dollar, a significantly faster pace than was the case in either 2005 or 2006. At the same time, I think it's vital to recognize that China's appreciation against the dollar hasn't really translated into a broad appreciation of the Chinese currency against other important trading partners of China. The renminbi has continued to depreciate against the euro, and it's actually depreciated against currencies like the Indian rupee and the Thai baht. So I think on a broad trade-weighted basis, the renminbi hasn't significantly appreciated. Now, looking forward, if the dollar stabilizes and if China continues to allow its currency to appreciate against the dollar, hopefully at some point in time that will translate into a broader appreciation against China, against some of its other important trading partners. Remember, China now trades more with Europe than with the United States, so focusing exclusively on the renminbi dollar as opposed to the renminbi euro is, in my judgment, a mistake. So far, the appreciation of the renminbi against the dollar has not had a significant impact on China's broader export growth, largely because of very strong growth in China's exports to the commodity exporting parts of the world and very strong growth to Europe. Looking forward, though, I don't think that it is realistic for China to be able to completely offset the impact of a slowing U.S. and the corresponding fall in U.S. demand for Chinese products and the ongoing renminbi appreciation against the dollar by increasing its exports to the rest of the world. So I think at some point, net exports will start to contribute less to China's growth. But given that China's economy has been growing so strongly, and given China's capacity to take steps to support its own domestic demand, I actually think that's a positive. I think directionally, that's what China needs. Moreover, I think Chinese policymakers are increasingly focused on the risk associated with domestic inflation, and a stronger currency would help there.
Okay. Well, while we're still focusing on the Asian economy, let's talk about China's neighbor, Japan, and their currency, the Japanese yen. We've seen the yen strengthen against the U.S. dollar recently, as well as the other crosses, simply because of risk aversion. We've been seeing plenty of volatility in the equities markets, and this has helped the yen as well as the Swiss franc. But the Swiss franc and the yen are considered funding currencies, and given that we've been seeing interest rate cuts here in the U.S., there is talk that the U.S. dollar may possibly become a funding currency. So, Brad, what's your take on that argument?
Well, I think there's a very critical distinction between Japan and Switzerland and the United States, and that is that both Japan and Switzerland have significant current account surpluses, meaning that they have surplus savings that they have to lend out to the rest of the world. They have more savings than they can put to work in their own economies, which is why their interest rates have been low on a sort of sustained basis. The U.S. is obviously in a very different structural position. It's a savings short economy that relies on inflows from the rest of the world. Given that context, it's hard for me to see how the U.S. dollar could become a funding currency on a sustained basis, simply because the U.S. doesn't have any spare savings to lend to the rest of the world. It would have to be attracting an overwhelming level of inflows in order to allow a certain level of outflows. And my guess is that that's unlikely.
Okay, and last but not least, I'd like to take a look at the GCC countries. In the past few sessions, we've seen a commodity rally with NYMEX crude oil back above $90 a barrel and gold hitting new record highs. But while we're focusing on the GCC currencies, I would like to get your take on the dollar peg for these oil exporting economies and what you think about that right now.
Well, you know, a topic that is near and dear to me. I have a very strong view that the dollar pegs in the Gulf no longer serve the interest of the Gulf economies. Right now, the Gulf economies are in the midst of a boom. They're starting to put their oil surplus to work domestically. That means more spending at home, more investment at home, and that is translating into pressure on domestic prices. At the same time, the dollar's weakness against many other currencies, the euro, but also against Asia, is putting pressure on the price of their imports. And you've seen a very significant increase in inflation throughout the Gulf. And at a point in time when oil is at 90, it doesn't really make sense for the currencies of oil exporting economies to be weaker than they were when oil was at 20. One would expect that oil exporting economies in the Gulf should trade something like Canada or the Aussie dollar, other commodity exporters that have, broadly speaking, rallied along with commodity prices. So to me, that's a very significant disconnect, and one that doesn't help the Gulf countries manage their own economies. I think that's broadly true for Russia as well.
Okay, Brad, thank you very much for coming on the show today.
It's my pleasure. Thank you.
This has been your Forex News with Brad Setzer, Fellow for Geoeconomics at the Council for Foreign Relations. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks ended the session with solid gains. Wall Street awaits the interest rate announcement from the Fed Reserve, due out tomorrow afternoon at 2:15 p.m. Eastern Time. The FOMC began its two-day meeting today. The market ended higher in anticipation of an interest rate cut at the end of the meeting. Taking a look at today's U.S. data releases, durable goods rose 5.2% in December. The core figure came in higher at 4.4% month over month. In November, durable goods climbed 0.5%, upwardly revised from the 0.1% decline. Meanwhile, the S&P's Case-Shiller Home Price Index fell a record 2.1% in November. For the past 3 months, prices fell 16.2% at an annual rate. And the Conference Board's U.S. Consumer Confidence Index fell in January to 87.9 from a revised 90.6 in December. At the closing bell, the Dow Jones Industrial Average advanced 96.41 to close at 12,480.30. The tech-heavy Nasdaq added 8.15 or 0.35% to 2,358.06, and the S&P 500 rose 8.33 points, ending at 1362.29. In the fixed income market, U.S. Treasury prices declined with yields higher on the day. The stronger-than-expected durable goods order report and U.S. equities strengthening added to the decline. The benchmark 10-year Treasury bond was down with the yield at 3.65%. The 30-year long bond was down with its yield at 4.34%. And the 2-year note was also lower with the yield at 2.278%. Taking a look at energy, NYMEX crude oil futures gained for the fourth straight session with prices up above $91 a barrel. In another volatile session, the market weighed tomorrow's FOMC rate decision, as well as whether OPEC will keep production steady. The March crude oil contract hit an intraday low of $90.33 a barrel and ended the session higher by 65 cents, closing at $91.64 a barrel. Taking a look at other petroleum futures, February heating oil added 1.53 cents to close at $2.54.18 a gallon. February gasoline gained 0.42 cents, ending at $2.32.95 a gallon. Meanwhile, February nat gas futures were down 8 cents, closing at $8.015 per million BTU. Over in the metals complex, COMEX gold futures ended the session lower but hit another record high at $933.30 an ounce earlier in electronic trading. February gold settled down by $2 at $925.10 an ounce on the COMEX division of the NYMEX. In other metals, March silver added 5 cents, closing at $16.80 an ounce. March copper gained 10.95 cents or 3%, ending at $3.29.90 a pound. This afternoon, we're joined by Justin Lewis from KS Futures. He'll recap today's action in commodities and give us his short-term outlook.
Good afternoon, Remy. Today's energy market was stronger across the board. In the crude oil, natural gas was a little bit lower, and the products were just a little bit stronger. Looking at the crude oil, it's really focusing on the interest rate probability that the interest rates will be decreased on Thursday, and that's helped this crude oil market out over the last week or so. And the economy as a whole has really been looking ever since they did the three-quarter decrease. Has really been looking up, and again, the Dow Jones is up probably 900 points since that occurred, and it's really helped out the crude oil market. A lot of analysts are looking at it going maybe $94, $95, and that would complete head and shoulders on the chart. Looking at the crude oil, natural gas is back down below $8. With option expiration yesterday, I felt that there was a skew at the $8 level, so they had to close above that. Now we're back down. Maybe continue on down just a little bit more. Looking at some of the other commodities, the most significant thing today was probably over in the wheat market. It was limit up and then almost went limit down, had about a 55-cent range in the Kansas City and Chicago wheat. Front month Minneapolis has probably been the strongest out of all of them, and it was still up the limit today at 13.27. Looking at some of the other the meat complex, feeder cattle were up $1.50, which is kind of off of Oklahoma City being 1 to 2 higher yesterday afternoon. And the hogs and pork belly markets have really shown some strength in here, and it looks like the meat complex as a whole is going to be stronger. Now, with that, back to you, Remy.
That was Justin Lewis from KS Futures with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.